So then he's going to go drive this asset for you. I'm just making sure I'm following, right?
Yeah. He's going to drive the asset for me. 30 miles out of his way. I don't think you have a family member that's going to drive 30 seconds out of their way for somebody.
Look, man, Robby's all about using resources. He talks about it all the time. I think he had his mom drive an asset one time. I don't know if we've talked about on the show or
first, seconds, performing, non-performing? What the f***? Note buyers, when it seems like you're in this business alone, know Chase, Robert, and the rest of their tribe are at it every week. They're bringing updates from their own note businesses as they work to find, fund, and finish deals. Follow along as they share their grassroots education with you, tuition free. If you'd like to know more about what they do and to download the entire back catalog, check out NoteMBA.com. Now, flying solo as today's host, Chase Thompson.
Hey everybody, welcome to the Note MBA podcast, your home for note investing on iTunes. I am Chase Thompson, normally joined by Robert Woods. He is currently either over the Atlantic or in some far-reaching European country. I'm not too sure. He will be joining us as soon as he possibly can, but I did not want to leave you alone per se for today's show, so I wanted to bring you an amazing interview with an incredible investor. He is a managing member of Prosperity Investment Fund, which is a real estate investment firm with over 20 years in debt collection experience. And this combination of debt collection and real estate experience, as I'm sure you know, gives a very unique perspective in this mortgage note arena. My guest today is Jay Tenenbaum. How you doing, brother?
Terrific, my friend. Nice to Thanks for having me on.
Yeah, and you know, one of the first things I want to address is I sent you an email and I said, hey, man, we've been talking about, we'd love to have you come on the show. And of course, I'm sad that Robby can't be here for this episode for our obvious, relationship, good friends and everything like that. To which you replied, finally, right? Like, we should have had you on like at least 20 times already. This is incredible.
Oh, just kicking it where I can.
Yeah, exactly, man. It's my bad. We definitely should have had you on here before. That's for sure. And actually, this is going to be something that not too many people know. I'm going to take just a quick step back into the history of the Note MBA podcast from the vault, as it were. When I originally had the idea to do this note investing podcast, it was back in October of 2014. I believe it was October. It might have been November, where I actually met you for the first time. I was doing a ton of interviews with a bunch of really cool people in the note space at a noteworthy conference in Vegas. And
That's right.
We did an interview by like some escalators when there was like a huge trade show of like, I believe it was tattoo artists or something like that was like going on, like the conference down the hall. I had no idea who you were. You barely knew who I was. And you took the time then, but the audio was totally whacked out because of whatever was happening inside of that, that casino hotel area. But the audio was totally whacked. So I've actually technically already interviewed you once, though I feel like this time's going to be a little bit better, I would hope.
Oh, for sure. I think we both have grown our businesses, et cetera, substantially since back then.
Yeah, for sure. And I just remember,
and our friendship.
Yeah. Oh, no question. Like I had no idea who you were. I'm sure. Oh man, I cringe to think about what that. Anyway, I'm so glad the audio doesn't exist. I just need to like splice it like in the middle a little bit of this episode. That would be great. But no, I appreciate you coming on the show. You have a unique set of talents for sure. Everything from the raising capital side, loss mitigation, obviously with your debt collection experience is really, really vital, is huge to this business. And I want to touch base on just a lot of different stuff. You, are you currently on slate to present at the IMN conference coming up?
Yes, I'm on a panel entitled "How to Get Your Non-Performers to Reperform" or something like that.
Okay, cool. Fantastic. And that conference is when again? I cannot remember the exact.
It's September 22nd and 23rd. The panel,
right.
the specific title of the panel is "Getting a Non-Performer to Reperform in This Low-Rate Environment: Workout, Modification, and Rehabilitation Strategies."
That is a title. There you go. That's a delightful title for a panel. So including IMN, you've been presenting at a lot of different events in a lot of different places. So I mentioned kind of pre-show. I want to talk a little bit about that stuff, obviously. But a few other things. I mean, you just like you said, our businesses have changed substantially. Things are very different to when we very first met, right? So, there's so many places I want to jump, but the first place I want to go is just give us a quick backstory. For those that don't know Jay Tenenbaum, just in general, just kind of how you got into the business, and just a quick one, too, so we can catch up to where you're at now and then dive in on a lot of those topics.
Sure. So my background, I was a practicing debt collection attorney here in California for 20 years with my wife as my business partner and my spouse. We closed the law practice in 2008, but yes, we're still happily married.
Delightful.
So we survived working together, and it's kind of delightful that we have separate business interests now. After we closed law practice, I started investing in judgment liens here in California and executing on real property was our model. We weren't garnishing wages or hitting banks or enforcing judgments traditional ways. We were just enforcing them through executing on real property. And I had the opportunity in August of 2013 to attend Scott Carson's 4-day No Buying for Dummies workshop. Certainly just became a different, that experience was a different debt instrument than I was used to working with. So it was an easy transition. And now, basically 3 years later, boy, how time flies.
I know.
We have bought 198 assets with an acquisition cost of a little over $3 million. The purchases to date have been accumulating total BPO value, fair market value of these properties is over almost $7.5 million. And we're just, we're buying practically every month this year. And just really enjoying what we're doing.
That's incredible. So close to 200 assets purchased, which is amazing. And to, I guess, get us started in that direction, right? Like you said, $7.5 million. You said in BPO, right? Close to that.
Yes.
There's a lot of areas that I feel like you do just a bang up job. One of the best I know of. And that's certainly in that private capital raising area. For a lot of the people that listen to the show, right, we have kind of that bell curve of listener, right? We've got that beginner that's kind of coming up into that, into that graph. And then we have that huge middle trough of people that are either doing this full time or doing it enough to where, they're making money and what have you. And then on the other side of that, we have people like yourself and a few other people that you and I know that are doing this really successfully, right? From a capital raising perspective, for that kind of middle to back end new individual, that's a really tough area to get started in. A lot of people just are not that experienced asking people for multiple thousands of dollars, right, for investment, or even to take a look at this opportunity, as it were. So what are some ways that you maybe in the beginning, but definitely just in general, kind of go about that, philosophically, tactically, in general, what are some ways that you could really speak to, clearly it's important, but how are you doing it?
Good question, Chase. Here's the story behind that. First of all, when I first got into this space, I envied those who say, okay, I moved over from fix and flips and other type of real estate investing, where they had their stable of investors they could just move over into buying notes because these investors already knew them, had a track record, had a history with them. I had absolutely zero capital raising experience before I did this. I was a debt collection attorney. I mean, we didn't raise capital. We just, that's just not what we did.
The people you were talking about getting money from didn't tend to have a bunch anyway. So it was very different situation.
You were resourceful in how to extricate it from those who didn't want to part with it voluntarily.
Right.
So that's not how I approached capital raising, by the way. So the starting point was I had some capital available to start myself. Through the Dummies class, I had partnered up right away with a couple of gentlemen that were already mastermind students of Scott's. And so we bought our first 3 notes, spent about $67,000. Immediately thereafter, I was presented an opportunity to buy 20 semi-performing, performing notes, and my family ended up investing in that, which I in turn resold the performing, got them all to perform and resold them in about 9 months and doubled my money. From there, it just really became, now I have a track record. So just putting, an executive summary together, which was part of my mentoring process with Scott's group, and a track record, a spreadsheet of the performance of what we've done, really started speaking, for itself. I'm not the kind of guy that's going to vomit my deals on somebody. It's really a matter of, here's who I am, here's what we've done, here's what our company looks like, and we have a peripheral conversation. I send in those materials. They call me back and say, I want to learn more. If I've got a specific deal, we discuss the expectations of a specific deal, and that's how we go from there. I was asked one time several years ago about what's my spiel, and I sat and I thought about it. I said, you know what? I don't have one. The documentation pretty much speaks for itself. And so as a beginner, my advice would be twofold. One, go to a family member, even though somewhat would be challenging. Go to somebody. Let's take a step back from a family member. Go to somebody who knows you well, likes you, and trusts you, to where it's not about what deal you're going to put them in. They're just all in because of the relationship that you have, whether it's a family member, a good friend, whatever. So it's just a matter of you're going to walk into this space together. The other thing is, which is what I advocate, obviously for self-interest reasons, is when you're beginning. I had the fortunate to my first 3 deals was with a couple of already existing mastermind students. While I knew how to build a business, I knew the process, I knew what to expect. Some of the little details, they, having had the experience of buying notes already, filled in the gaps for me, and it was very beneficial. When we work with our joint venture partners, we will teach them how they can be involved in however capacity they want. There's really not a whole lot of secret sauce in this business. We've built this business to the extent that we have. It can be replicated by anybody if they have the desire to make this a full-time business, which is what we do. Yeah. So, partnering up your first deal or two with someone with experience makes a total lot of sense, because we can teach you, we can ramp up the learning curve substantially. We can teach you what we do.
Yeah, sure.
Take the good and the bad, but it's just a matter of, this is what we do, and we have no problem being transparently showing you what we do.
Yeah, and we've talked about that on the show before. I mean, it really allows you to get into it. I think it does a couple of things. Number one, it gets you enough into the understanding to go, I want to do this, as well as understanding what it is, right? Like, some people will get into the thick of it and go, holy cow, like, this all still makes sense, but I don't want to do this. Someone else is more than welcome to do it for me, right? But, like, I don't want to do this type of thing, right? Anything, you can do 100 different things to actually make money, right? But this might not be the thing for a lot of people. And so it really gets you into the understanding of, like, I want to do this thing, right? Like, you and I both love this thing. So it makes sense, right? But number two, it also gives you really great case studies. If you do plan to move forward, presumably really great case studies, right? And that's what you were talking about in reference to, like, the document does the work. If the deals make sense, the deals make sense. Here's the numbers of what we have, done in the past, kind of thing. Letting that experience, letting those skins on the wall kind of speak for you is a good way to kind of raise capital, is kind of what you're saying.
And not only that, but when you partner up with someone with experience, you get instead of you're by yourself, if something happens that goes sideways, you're going, oh crap, how am I going to handle this? And you just get wait a second, we've done this before. We've experienced this. This has happened. I mean, Robby's the first one to admit his when things don't go as he expected, take the responsibility for that. And it's just a matter of, hey, we've been there, done that. Here's how we work through it. I have my biggest fault is that when I do things as repetitious as we have, when you buy almost 200 assets, things get somewhat repetitious at times. Sure. My biggest fault is when I'm explaining somebody how things are done, I inadvertently jump right to the end. I tell you how the story ends without telling you how the story goes.
Yeah, right.
My biggest fault.
You just kind of the punchline it, right? Like, I've no jokes set up here, people. It's just punchlines all day long. So yeah, that makes sense, right? I mean, once you've made the recipe enough times, you just kind of like, yeah, it's a couple eggs, it's a little bit of flour or whatever. You mix it and put it in the oven, and it comes out. It's delicious, right? Like that. I mean, you jump quickly to that because you've just made this recipe so many times. It makes perfect sense. Not really too surprised about that in general. So, so you've done that capital raise piece. You've kind of let that experience speak for itself. You've sought out experience to be able to get that, right? And then you dive into some deals. Obviously, you've been able to dive into a lot of deals. And we all know very quickly, being in this business, the second you dive into oftentimes just one deal, but by and large, a handful of them, eventually you're going to get to that lovely space, which you have a keen knack for, of loss mitigation. So loss mitigation can go a lot of different ways depending on the tactic with which you take it. And I love the way that you approach it. Especially one of my favorites is whenever you talk about that, that first line you like to drop on a potential borrower when you get them on the phone or whatever the case may be. But I really do enjoy your approach. I like the way that you go about it. Talk a little bit about that. Talk about some really great stories maybe you have from the loss mitigation space, but how you go about that process, I think, says a lot about you, and kind of speaks to some of that success you've been able to have.
Sure. First of all, with the debt collection experience, I was never the one that, would tell you, hey, pay or die. I really was never that hardcore guy. And everybody's got their own unique style of experience of debt collecting. Mine was always kind of just establish. I don't want to necessarily say establish a relationship, because I'm not necessarily a relationship kind of person. I was at a networking event some time ago where the speaker got into, kind of characterizing people. I mean, we've all been through the exercise of whether you're a 0 or an X or an O or a square or whatever. And I was kind of checking out, just wanting to network some more, waiting for the presentation to end. And she started going into one of the quadrants, and she said, this person just wants the facts. Don't ask him how the weather is. He doesn't care. He talks fast. He talks with his hands. Now, if this was live, you'd see me talking with my hands. I obviously talk fast as it's coming over the air. She certainly had me described as a T. Yet, when I'm doing my loss mitigation, for whatever reasons, just because I guess my why, I'm establishing deeper relationships with my borrowers. What Chase was alluding to was the fact of my approach is typically I get a borrower on the phone, and the first question, I have no script. I have no idea where the conversation is going to go. And basically, but I start off with, how may I help you? And either I get met with silence, fear, apprehension for about 30 seconds. When they realize that someone actually wants to talk to them and is not beating them down to pay them, make demands on they can't meet, then they start vomiting their country western song. They tell me everything in the brother of what happened, why it happened, how it's going to happen, and everything else. And all I do is listen. And invariably during that conversation, you get but I want to pay you X. Now, when it comes out of their mouth as offering it to me, it's something that they already know they can make. So my default rate on my loan mods is probably less than 10%, because they're making a commitment that they already committed to. And just so the key there, if you don't try this at home necessarily, but the key there is listen. You pick up more by listening than anything else you can do with regard to loss mitigation. Now, as we've grown as a company, as some of you may know, we also engage primarily to do most loss mitigation these days is with Polaris, which is a third-party credit counselor. They approach the borrower similar to what we do. They are a nonprofit credit counselor. They take the approach with the borrower as the borrower's advocate. Let me help you talk to your lender for you. They're not negotiating with the borrower. They're just talking with the borrower. The borrower then will make the same proposal to them, and all they do is relay it back to us proverbially. And we make deals happen that way. With regards to some of the stories that Chase wants me to tell you with regards to making connections, a couple come to mind. One is, which I kind of love to tell, is we bought a property in Toledo, Ohio, a note, an occupied note for 0. When I was buying those 20 notes, we were looking for, as they were to perform 100%, looking for a high 20s, low 30 type of return, and we settled on a pool of 20. And right at the very end, they couldn't find the collateral on a loan, so they just added one for free, so they wouldn't skew the returns. And I bought the note. Well, like I said, I bought the note for zero. The property was only worth about $4,000 as is. He owed only about $9,700. I called him up one day because I thought he was delinquent. He said, no, I make my payments in advance. And I went back to my FCI servicer's back office, and I looked to see, sure, the payments were there. And before I let him go on the phone, I said, are you interested in doing a short payoff? And he's like, sure. So I wanted to ensure. And he also said that his next 3 payments in advance were already being set. So I confirmed that the payments that he said were there were there. I waited until he sent the other 3 payments. So I had about $1,100 in my pocket, something I bought for zero. And he's blowing up my phone. When can we talk? When can we talk? So I had a conversation with him, and I did my homework. I knew that while the unpaid principal balance was only about $9,700, I ran the amortization for the rest of it. And knowing that if he would have carried it out to term, he would have owed about $12,000, $13,000. Because the first conversation that he had, the first question he asked me was, what do I owe you? I said, well, the principal balance is $9,700. He said, well, how about if I pay you half? Well, I had about a $7,000, $6,500 figure in mind, even though I paid zero and it was already up $1,100 anyway. And so I said, explain to him that $4,500 was probably a little light, that you could continue to make your $200 a month payments and you'd be paying $13,000, $14,000. We settled on $6,000, $3,000 now, $3,000 in 30 days. He calls me back the next day, and he says, I went through my cash flow, and how about if I pay you more money for an extra month? What do you have in mind? He said, how about $6,200? Now, I already knew he had $3,000 in his available, right? I knew his cash flow was probably on the back end. He wasn't confident he'd have the $3,000 in the other 30 days. So he said, how about we do $3,000 down, because I knew I already had it, $2,000 the next month, $1,200 the month after. Done. Now, while that's a delightful story, the reason I bring this up is we bought an asset in Bowling Green, Ohio, or Custer actually, which is outside Bowling Green. And I called him up one day to see if he knew a realtor in the area. Now, this, I guess from what I understand, is where he is in Toledo and where this property was in Custer is about 30 miles away. Mm-hmm. He says, I will, when I'm out of class, I guess he's taking some night classes, I will go drive by the property myself. This is a borrower, right?
Wait, tell me. So this is a borrower who paid you on something you technically, you paid for the pool, right? But this was not necessarily one of the notes that really cost, part of the deal. So he paid, and then, all right. So then he's going to go drive this asset for you. I'm just making sure I'm following, right?
Yeah. He's going to go drive the asset for me. 30 miles out of his way. I don't think you have a family member that's going to drive 30 seconds out of their way for somebody.
Look, man, Robby's all about using resources. He talks about it all the time. I think he had his mom drive an asset one time. I don't know if we've talked about on the show, or I know I certainly haven't, and I don't think Robby's had an actual borrower drive an asset before.
Yeah.
That's crazy.
It's just a connection that you make. He's living in his house free and clear because it was an easy conversation.
Right. Well, sure.
I bought it for zero. I made $7,300. Do I care? Was I out to get every dollar? No. And he's living in something.
Future challenge to any listeners of the show that are going to come on and be interviewed by myself and Mr. Woods. You need to get your act together if your borrowers are not driving assets for you as well. That's amazing. But that really does speak to the relationship. So on the flip side of being able to apparently make incredible relationships with borrowers and people to be able to raise capital, you mentioned before that you'd gotten started with some guys, and then I know that you had kind of another group that you were working with, and now you're kind of the Prosperity Investment Fund. Can you talk a little bit about that? Talk a little bit about the relationship building, as it were, as far as building out your organization, having the people on your teams, things like that. Kind of talk a little bit about those partnerships. some of them did not work out. I would assume potentially from that first partnership that you had, one of the guys had just discussed or had discovered kind of like what we brought up in the beginning, which was just like, maybe this just wasn't for him, this type of business or whatever the case may be. But talk a little bit about the partnerships. You haven't really gone at it too much so alone, as it were. So can you kind of speak to that a little bit, maybe for those that are either just upstarting or maybe you've got a successful business but you want to partner up,
Sure. So with regard to the first partnership, where we bought the 3 notes, it really wasn't. I'm still friends with all 3 guys, very much so. Actually, all 4 of them. It was just a situation where one guy has a full-time job, so he's always been a part-time investor. The other guy is a good friend of mine. In fact, I talked to him. I saw him this Saturday. He's bought some assets from me. We've invested on some other stuff. And it really was, we kind of deployed all our available capital at that point in time to really have any traction to move forward. That, and when I approached my family member for the pool of 20, the only stipulation my family had was, your partners may be great, but I don't know them. So if we're going to do this, it's just going to be you and I. Like, fine, which everybody understood. And like I said, I maintained those relationships. From there, we just grew, formed our own company and move forward. To answer your question, it's all a matter of when you have partners is the keys are understand each other's strengths and weaknesses, divide up the responsibilities, and to grow, learn how to outsource most of your work. There's only so much you can handle in-house. We have a terrific base of outside vendors that we use, from our third-party credit counselor, from our servicer, for a variety of different vendors. That all work in connection with us. Now, the other thing is being in a debt collection law practice, and my each give you a little more background. I was brought up in the service industry. My mom owned a catering service for 40 plus years. My dad owned restaurants. So I have a kind of unique understanding that as a service business, you'll never service all your clients all the time. Just understand that.
Right.
So if you have relaxed expectations, then you develop strong working relationships with your vendors. You may have to replace vendors from time to time. They may have some internal changes that you can't control. They downsize, they lose key people, whatever. It's not about jumping ship so much. It's just a matter of, can they still do the work that they promise you to do? And if not, you have to replace them with somebody else. But it's not about, hey, if things go south, I jump ship and go on to one of their competitors. No, I give them the courtesy of a conversation saying, here's the issues we're having. Can we work these out? And same with us. Hey, how can we do a better job being a better partner with you? And so we pride ourselves on our vendor relationship. I think it's the key to how we've grown. Without them,
on those specifics of that vendor relationship, you've also done a really good job, and this is something that Robby's done an excellent job of, and a lot of other people that we know. To have the success in this business, you need to be able to build those really great relationships with sellers, right? With note sellers, to be able to find these assets, find these deals. Just a quick insight on being able to build those. I know you've got a great bit of secret sauce that maybe you don't necessarily want to tell the whole story on enough. But what is some really great advice you can give some of those people on that, building great relationships with sellers? What other than just obviously meet expectations, actually buy products you say you're going to buy. I mean, these things all seem very obvious. Are there other things that people might be missing?
Yeah. Good question. Okay, just to give you some background. We bought 198 assets. We've only worked with 12 sellers. We've been able to establish those relationships to go back to other sellers. I mean, I bought probably 100 assets from one seller, 65 from another, and just develop those relationships. And I think the two keys that as I look back, is obviously when you close, you establish the credibility and that goes strong to relationships, right? When you close, if you're kicking tires and messing around, you can only go so far, and then either you or the seller or both of you kind of lose interest with trying to work something out with each other.
Right,
point.
sure.
And it's reciprocal. I mean, we've tried to work with sellers that they don't get back to us on our offer. Their pricing is just extraordinarily high. It just doesn't make sense. I think the other key is, and not because we bought as many assets as we have, I think we kind of did this from the beginning, was two things. One, we're clear in what we want. We explain to a seller, here's what we're looking to buy. If you can accommodate us, here's what you're going to get in return. Probably buying from you once a month.
Right.
Or
right.
once a quarter. I mean, it's not just going to be here, I'm buying you one note and see you buy it. So I'm going to buy 10 notes from you this month, and I'll probably come back and buy 10 notes from you the next month.
And you started with that level, right? I mean, not that level of necessarily purchasing of an inventory, though you did. You started with that level of intent in terms of the conversations, and that's huge.
Yes. We said we were very clear in what we wanted. My 26-year-old son, Eric, is the director of acquisitions, and he's the one that builds these relationships. And in the beginning, when he was playing with joker brokers, Daddy told him so, and it took him a little while to say I was right. When he was fooling and wasting his time with people that weren't legit, I explained to him, look, you need to be clear on what you want. Here's who we are, here's what we do, and here's what we're looking to accomplish from you as a seller. If it's a good fit, great. And it's not just about price. It's about we know what you want up front. When evaluating your assets, we know what pricing expectations you're looking for. Mm-hmm. Therefore, we're picking out assets. We're cherry picking the assets that we're picking out, knowing that this is the price that you want, and that price makes sense to us as well. We're clear on we want to come back to the well over and over again if we can. That's fine. These are the assets that we're looking for. Here's what we want to do. In raising capital, timing is always key. So oftentimes we've run into challenges where we don't market our deals for raising capital till the diligence is done, but you've got about a 30-day window to get your bid accepted to closing, and it could probably take you a week or two to get your diligence done. So now in the beginning, I was going to investors going, can you make a decision in 5 minutes? And that wasn't fair to them. And by hook and by crook, I was able, even on a first rodeo with a couple of sellers,
you made
go to them and say, hey, my dog ate my homework. Can I have an extra week? And they did it.
Love it.
And we closed.
I love it.
And so now it's a relationship where when I need something, they're all over it. When they know what to expect from us. We had a situation which it was broadcast a while back, where we had built a pool specifically for an investor. Usually we buy, get a bid, get it under contract and get the diligence finished, and then go, market it for investor partners. These guys came to us and said, we have X amount of dollars that we want to deploy with you. Go find us the assets. So we did. 11th hour, they just walked away. I don't know what the real story was or whatever. It was really kind of so baffling to me. But I went to my seller and I said, look, because this was a little unique. It was a larger trade, 11th hour. I didn't have any expectation. I'm promising her that it's going to close on time, and I got to tell her the day before it closes that, oops, we got a problem, which is just only a ruse. See, if I would have known in advance, I could have used the dog ate my homework line, but this one came about by accident. So I went to her and I said, how about if I give you a $5,000 good faith payment for an extra 2 weeks? She said, you got the 2 weeks. Don't worry about the $5,000. You're good for it.
Oh, wow. That's awesome.
Yeah. I mean, so that's how we develop our relationships. You close is key. It's tantamount to credibility, and just be clear on what you want to accomplish.
Yeah. On your actual intentions, for sure.
And you find some trading partners may not be interested in that, and so you move on to someone else who will. That's fine.
Yeah, for sure. Absolutely. And one of the last things that I wanted to touch base on, on this idea of kind of the business is evolving and changing and moving, doing all those kind of moving pieces parts, is a portion of your business has changed dramatically. I believe, I would say that, definitely corroborate if so. And it's something that we've dabbled in and we kind of see the power in, but it's definitely something you've got to do right, or else you could find yourself in a really not so wonderful situation, and that would be seller finance. I heard you talk a lot about it the other day, and I definitely wanted to talk a little bit about it here. But you've really changed, and you've got a really great model for this, right? I mean, for the seller finance and how you're managing that within your note deals, correct?
Yes.
Yeah.
Yes.
So, like, to dive in on that, like, that was really, really cool when I was hearing you talk about that the other day.
So here's the evolution. We have purchased, out of the 198 assets, we have purchased primarily low balance owner occupied notes, getting borrowers to stay in their homes, and that's the why. We've been buying since November, buying a lot of defaulted seller finance REOs, and invariably starting to buy some higher value assets just to, as we're getting attracted by institutional capital at times, they want to see some history of some higher value stuff because they're scared to death of low balance stuff, even though the returns are phenomenal, as we all know.
Right. Yeah.
So as we became as the occupied notes, some of which borrowers just can't get out of their own way, you took back as foreclosures. As we were buying the REOs and the REO portfolio portion of our business started to grow, I had reached out to a national loan officer out of Cleveland, National Lending Unlimited, and we started working together on. He originated Dodd-Frank compliant seller finance paper, so the relationship morphed from just a vendor to a relationship where now he's one of my partners in prosperity. He's a former banker. So what he's taught me after all these years of doing it this way is there are several ways you can monetize. Some people could talk to him and say, people talk at times about as you're generating wealth, you want those who generate wealth through multiple streams of income. Okay, which are independent streams of different or related things that you're generating from on a monthly basis. What he's taught me, and how we built this REO side of our model, has been where you create the monetization or the several revenue streams inside the same asset. What I mean by that,
okay.
What I mean by that is,
let's talk about that, right?
I will market an REO for sale. There's three primary exits, four actually, that we do on a daily basis. We will just sell them for cash to a wholesaler in the area. Great, not a big deal. Nothing sexy about it. Everybody does that. You just build your buyer's network, and it's not a big deal. That's fine. You sometimes we don't do as much of that as we do the other three, not because we're greedy, just because we see bigger upside potential in the other three. The other three are, we will fix and flip properties ourselves, but we'll only do those that provide the highest returns. Just like, as an analogy, in this business, you're always told that no matter how big a pool that you're going to buy, you're going to mod out a third of that pool, you're going to get a deed in lieu of a third of that pool, and you're going to foreclose on a third of that pool, right? Through Polaris, et cetera, our loan mod performing portfolio is about over 40% rather than the third. We're a little above industry average. So, but on the seller finance side, using that same third analogy, we will fix and flip probably less than a third, and we're probably running the rest of the 2/3 or 3/4 is probably half and half between selling to an end retail buyer, or as a fix and flip, as a fix for property, or selling to an investor fix and flipper. And I'll explain that in a second. So for example, let's say I had 4 assets. I would probably fix and flip one because it had the highest upside profit potential. I will probably sell to an investor fix and flipper 2, and I probably would sell to an end buyer a 4th. Okay. Now with the end buyer, you're cleaning the property out. You're putting kitchen cabinets on, you're making sure the doors, windows work, stuff like that. But you're not rehabbing the property. But you're but you're having that similar discussion with a borrower to say, what can you afford? And you kind of build it from there as to, I can afford $500 a month. You kind of take as a baseline 9%, 20-year term. You get a price that comes out to about 75% of an ARV value. You don't want to sell a fixer at full market value. You get in trouble with Dodd-Frank over selling crappy houses for full value. So they know it's a fixer. They have the ability to fix it themselves. For example, we did one. Quick story. Some of you have heard. I ended up moving a former borrower of a property in Oklahoma back into her property where she moved away and moved to Georgia. We bought the property for a little over $14,000, and when I moved her back in, we moved her back in at the same price that she defaulted on with the prior seller and had been evicted already, for $37,000, $1,000 down payment. She's paying a principal and interest payment is $332.75 a month for 20 years at 9.38%. For those of you at home, it's about a 31% return annually, but it's going to be over 20 years.
Let's look at the scoreboard. All right, looking good.
So you've got with when you're selling to a retail buyer, you're getting higher margins. Like I said, I'm getting a spread between 14 and 37,000 payable over 20 years, or refinance me out in the next few years, whatever it's going to be. You mentioned that Dodd-Frank rule on that selling a property in a certain situation, having certain disrepair or what have you. Is that an exact rule, or just a bad? I mean, obviously, just a bad idea, but just a bad idea.
Yeah. Because it just potentially puts you in bad light, or is that like an exacting rule? Do you know of off top?
It's probably somewhere in the area of predatory lending, like we
right.
all know.
Okay, so yeah, that's what I would assume. I'm just making sure that I'm not I knew where my bearings were.
It's not a good business practice, but it's
certainly not. Most definitely
predatory
not.
lending to say the least.
Yeah, definitely. And then you couldn't get refinanced. I mean, it poses all types of issues. I just wasn't sure. I had never heard anybody specifically address it that way. So yeah,
that's correct. Yeah. So then when we're selling to investor fix and flippers, here's where we're really getting to the monetization of assets. So we will sell a deal to an investor fix and flipper. Obviously, the investor is looking to make a profit margin when he fixes and flips the property, and that's fine. So you want to be able to be flexible enough to say, basically, you can almost take any property, and if you're going to provide the financing and even perhaps a construction loan, the investor fix and flippers is attractive to them because they're not putting their cash out, deploying their cash, which is key to them in having their cash outlay until the property resells. Obviously, I was talking to a guy the other day, and I freaked him out because I said, well, under our model, he comes to me and he says, I can buy your house all cash. I'm like, that's fine. But see, when somebody comes to you and saes, an investor says, I want to buy your price all cash, they're looking for that huge discount return, which we may have some assets that make them fit that model. That's fine. But the ones where the deal gets a little skinnier, rather than lose the opportunity to resell the property anyway, you basically can be creative with the seller financing. So I told him, I said, well, your cash price is going to be more expensive than your seller finance price. Now that doesn't make sense initially, does it?
No.
Everybody's taught that cash is king. You get bigger discounts with cash. Well, no. What you do is, if you're paying cash, great. The deal's got to make sense, and the profit margin's got to be there for both of you, and that's fine. If I'm going to seller finance it for you, I have the component of getting the year's worth of interest, 8% interest, as well as I'm giving you a construction loan, I'm getting another 14% interest. So if I'm getting the interest payments from you, I can justify lowering my purchase price because I'm making it up on the financing. Now, before we get there, what we typically do, okay, to explain to you when we're doing the retail, I'm pretty much building it from what the buyer can afford to pay. When I'm doing the investor fix and flip, I'm basically starting out with whatever our cost basis is, putting a profit margin into us at 30%, because we didn't want to model it with regard to being dependent upon the amount of interest-only payments we're going to get, because we had no idea how long the investor would hold the property before he resold it. So basically, the purchase price is 30%. Now, if the investor who's getting 30-year paper, 8% interest only with a 12-month balloon, so he's taking us out in a year regardless. If he doesn't take us out for a year, the return on investment is 39%. Now, if he decides to, or we decide to offer him the construction loan, we're now doing putting a construction loan on top of the purchase of the property. and that is a 10-year loan with a 12-month balloon at 14% with a 1-year prepayment penalty. So whether he holds it for 1 month or all year, we're still getting 14%. What we do with the construction loan is our capital partner takes all the 14%. We don't get any piece of the construction loan. Mm-hmm. With regard to the construction loan, so you with a REO, you have – so how do you minimize your risk? So the two questions I get asked all the time are, what happens if the investor defaults? Well, first of all, we vet the investor. We vet his general contractor. We make sure that they know what they're doing. Although some of the conditions, some of these properties, even after we clean them out, they couldn't screw up this property worse than we're delivering it to them anyway.
Right, sure.
But even with that is under the seller finance, we retain title, and all we do is give the investor possession. We get a release agreement up front, so if they default, I don't have to evict or foreclose or whatever the state procedure is to reclaim possession from the investor. With regard to the construction loan, which actually becomes a first mortgage on the property, we get a signed deed in lieu concurrent when the deal closes. We also manage the construction loan through fund control, whereas we only will disperse draws upon verification of completion of certain work. So we minimize the risk very, very, very well, very tight.
Yeah, and that's definitely going to be a more advanced strategy, I would assume, just in general, right? For a typical person kind of entering the space.
Or partner up with us and we'll show you how to do it.
Snap. There it is.
Because we do it very well.
I love it. So that is incredible. So we've talked loss mit, we've talked seller finance, the relationship building, the capital building. Anything else, Mr. Jay Tenenbaum, that you feel like the Note MBA community could learn from you today? Any last parting shots for them?
Could learn from me today. If I taught you what I knew in the next half an hour, your head would explode.
Oh my gosh. Look at this guy. I love it.
I will just say this. I'm having so much fun in my life. I make the reference. I mean, even though I have a very nice office overlooking the water in Newport Bay, I don't tell myself that I go to work. I go to my office. I truly enjoy what I do on a daily basis.
Funny story. I've started to use that term. I cannot tell you when I heard you first say that, but I've actually started to use that term at my house. Not necessarily just because I wanted to start loving my work or whatever, but more specifically with my daughter, my oldest daughter. She would use work in such a disparaging way. Not that I would say it in a disparaging way, but it became connotatively disparaging because then that meant I was leaving or I had to go get something done, right, or whatever the case would be. And I didn't want to. It sounds so weird, but I didn't want to make this notion of work disparaging to her because I think that whatever it is that you do, I think it can be great and it can be really good and fulfilling and all this other stuff. And so it was this really bizarre way of just kind of A/B testing this idea of when I grew up, my dad was going to work. It was that my whole life pretty much. And then I heard you say that. And so now I go to the office and so I use that in that same way. And it just seems like a better connotative word and it takes that bad connotation off of work in general. So you don't know that, and I had not ever told you that before, but I wanted to let you know that potentially you're changing things around the Thompson household without even knowing it about these connotations on words and what have you. So no, I appreciate you for that as well.
Thank you. And actually, part of that even gets a shout out to Robby because when him and I were in Chicago in April of 2015, driving around South Side looking at about 40 properties, we're driving around and he turns to me as he's driving and he's like, this isn't work, is it? This is just, what is this? This isn't work. So that kind of got me on the idea that I don't go to work. I just go to my office.
I love that. I think I saw that video. I think that might've been, I think I saw that forever back in the day. Anyway, Jay, I appreciate you so much. Before we cut out, please let everybody know where they can find you if they have any questions for you or anything like that. And of course, everything that we've talked about today, as well as any great contact info that Jay throws at us, will be included in the show notes over at Note MBA. So let us know, man.
So you can reach me two ways. My phone number is area code 458-6317. And you can reach me by email as well at jay@P as in Paul, invest, IN, V as in Victor, EST, fund, FUND as in David.com.
Fabulous. The bravest man on the planet. He's putting his phone number on iTunes. I love it. We appreciate you so much. Thank you so much, Jay. Thank you, everybody who took time to listen to this week's episode. We appreciate you very much. If this is your first time here, be sure to head over to iTunes. Give us a rating. Give us a review. You know we love those. And as always, be sure to tell 5 other people this week you know about the Note MBA podcast. Catch you guys next week, and hopefully Robby will be back. Bye, guys.